Hello, everyone, and thank you for taking the time to watch part one of the presidential elections videos. Welcome to our discussion, which consists of two videos. The first examines how certain economic metrics and indicators performed during the Trump and the Biden presidencies, while the second focuses on the impact on financial markets and various currency pairs. Before we proceed, we must understand the risks involved in trading. It is important to know that losses can exceed deposit and past performance is not indicative of future results. This video is not intended as a trading advice or a recommendation to buy or sell any currencies or instruments. Please take a moment to review the disclaimers on the screen. Thank you for taking the time to go over the disclaimers. In part 1, we will go over an introduction, then the US inflation, GDP growth, and the job markets during both presidencies. First, we need to remind ourselves that inflation measures the change in prices for goods or services. A robust economic growth may lead to higher inflation, while economic slowdowns can lead to lower inflation. The Federal Reserve, often called the Fed, plays a pivotal role in managing inflation. It sets an annual inflation target of 2%, a practice followed by most global central banks in major economies like the EU, UK, and Canada. The Fed monitors economic conditions and uses various tools to manage inflation, primarily by adjusting interest rates. Certain fiscal policies implemented by governments, for example, higher taxes may lower inflation, while higher government spending can lead to higher inflation. The chart we see on the screen covers inflation in different economic zones around the world. It compares inflation between the US, Europe, UK, Canada, and Australia. The chart we are looking at is for the US CPI, Consumer Price Index, which is an inflation measure, and it looks at inflation or the indicator since 2007 until now in 2024, and how inflation figures were during the two presidencies. As we can see, during the Trump presidency, inflation remained near the Fed's target of 2%. A couple of minor spikes above the 2% during the Trump's presidency. Shortly after the Trump's tax cut, inflation went as high as almost 3%. Then shortly after, it declined back to the Fed's target of 2%. As COVID-19 began, inflation dropped significantly due to economic inactivity during the pandemic. And as the Trump administration signed the COVID stimulus bill and economic activity began again, inflation continued to rise from the lowest level we can see here back to the Fed's target of 2% and much further. The Fed had to intervene twice. First time was here, cut by cutting interest rates, and then as the stimulus bill went into effect, and inflation continued to rise, the FOMC, or the Federal Reserve, began to raise interest rates again. As for the Biden's presidency, the pandemic effects remained and the COVID stimulus continued. However, the Biden's presidency faced a shortage in raw materials needed for manufacturing and also faced disruptions in the supply chain resulting from the COVID-19. During this time, inflation peaked and went as high as 9.1 on the CPI indicator. The war in Ukraine also impacted inflation due to the rise in oil price. However, it didn't last for a long time. Later on during the Biden's presidency, Inflation Reduction Act was signed and the Federal Reserve raised interest rates 11 times within 2 years, taking inflation down all the way to 3.4 where it currently stands at the moment. Now we look at economic growth, and for that we will look at GDP, the gross domestic product. The Trump's presidency witnessed steady GDP growth and economic expansion. The policies implemented by the administration, including the Tax Cut and Job Act of 2017, the deregulation and government spending, kept a positive GDP during the presidency except for the COVID-19 period, which can be considered an exception. The administration also implemented tariffs on China, which had a mixed impact on various sectors of the economy. As for the Biden's presidency, it started with the pandemic effect, a historical surge followed by a historical decline, taking the GDP back to its pre-pandemic levels. The GDP continued to grow during the Biden administration except for 3 months in early 2022 when GDP dropped from its peak of 7% down to negative 2%. The drop preceded the first FOMC rate hike and the war in Ukraine. Shortly after, GDP growth resumed and currently stands at 1.6%. The infrastructure investments, the American Rescue Plan Act, and the fiscal policies implemented by the administration were also the main factor in GDP growth. The number of jobs openings, excluding the farming industry, grew differently during both presidencies. The chart we are looking at covers job openings during both presidencies. The Trump presidency witnessed steady job growth, which lasted until the end of 2018. During that time, job openings increased by approximately 1.6 million, reaching a peak of 7.6 million. However, the job openings declined during 2019 by around 900,000. As COVID kicked in, the job numbers fell sharply. However, job openings rebounded to Trump's term job openings averages afterwards. During Biden's term, job growth grew significantly, reaching a new high of 12 million in March 2022, followed by a decline, with a current reading of 9 million. The remarkable job performance during the Biden administration resulted from the post-COVID rebound, the economic growth during the term, and the fiscal policies implemented by the administration, including the Rescue Plan Act passed by Congress in early 2021. Thank you for taking the time to watch our webinar. And if you need to explore more webinars or looking for more information, please visit our webinars and event section on the link displayed on the screen for the list of all the upcoming sessions. Thank you again and see you in part 2 of the presidential elections video.